Good afternoon. You're watching Modern Wall Street. I am Stephen Guilfoyle, and to my right is Olivia Voznenko.
Thank you for introducing me, Stephen. This is a first. It's nice to have you co-host our first show.
Yeah, well, it's nice to be here. It's nice to be asked to do such things.
Absolutely. And talking about doing things, I mean, let's take a look at the markets this week. I think they have more ADD than my millennial crowd. What do you think?
It's really incredible. I mean, here it is mid-Tuesday, and the markets, which were down pretty much since I wake up around 4 in the morning and I get right to work, and the futures markets were already deep in the hole. I figured they had to give back a little bit of what they gained yesterday because the infrastructure plan and the budget plan, the president's budget plan, really based on things that probably won't come to fruition, or at least not in their full effect. So I figured they had to give back a little bit, and it looked like they were pricing that in this morning, but Jay Powell speaks positively on supporting the marketplace, or kind of does, at his ceremony, and then here come the markets back on the plus side.
Yeah, I saw the Dow was down like 129 handles, and then, just like these markets are doing, it's just flip-flopping. But you say it's because the president's speech?
Well, that was why yesterday. That's why the market was so hot yesterday, at least the second half of that rally.
So you're not saying it's a dead cat bounce?
No, it's not a dead cat bounce.
Why not, Stephen? Why not?
Well,
Stephen's throwing shade on the dead cat bounce.
When you hear a talking head on TV or on the radio speak about a dead cat bounce, to me, I hear, I don't know, man. That's what I hear. No. If someone is to say that it's bouncing because it went down so far and this is a dead cat bounce, that means that you really don't have a good reason for why the markets are bouncing. But things always happen for a reason. It could be technical, it could be fundamental, something may have changed, maybe some kind of projection changed, maybe policy is looking different. But there has to be a reason for a movement. And I think you really have to look a little deeper than just explain it so flippantly.
Well, okay, so flippantly, like flip-floppingly. All right, so Stephen, I mean, we have a big inflation number out tomorrow, CPI, right?
That's the focus of the week.
Yeah, exactly. So do you think that has to tie into why the markets could potentially freak out?
Well, that's what kicked off the freak out, even though it was related to the VIX and exotic VIX type products. The reason why the markets initiated that freak out about a week and a half ago was because of inflationary fears. Inflationary fears that were really unfounded because they were kicked off by the January jobs report, which showed a 2.9% year-over-year wage increase. Yes?
Yeah. Okay, go ahead.
But what the media failed to grab onto was that the average work week actually declined. The average paycheck across the country actually declined by $2. So many people were led to believe that there was upward inflationary pressure from an average Joe or Jane who made $2 less a week than they had the month before.
Yeah, it was the managerial positions that actually were profiting from
right.
this.
Now that many managers, hiring managers and HR managers feel that the job market is getting to a very tight place, they're looking at preserving their better employees, and those are the people that might be seeing the wage growth. See,
Stephen, this talking head did her homework on wage inflation. What do you think about that?
Oh, I know you do your homework. I've been aware of that for quite some time.
Now, do you think that this, obviously, we're going to spend more in the government, right? Back to that, right? That's not stopping.
No, not at all.
So could that be really throwing off?
Well, the deficit spending is so far out of control at this point. It's been out of control for quite some time. It didn't originate with Donald Trump. We had horrendous deficits throughout the Obama years. We were trying to save an economy. I'm not going to cast any positive light or negative light on either president, but we got into the habit of spending much more than the government had in terms of revenue. And it looks like Donald Trump, although with different priorities, is headed down the same path. Although he, in his budget, does have some room for austerity. I mean, still increased spending with lower revenue, but there are areas he would like to cut. The deal that Congress passed last week is pretty much saying, no, we're not even going to worry about cutting a thing till after the midterms.
Yeah, but in terms of Treasuries, there's going to be an overabundance. Aren't bonds going to go down
Well,
go down Wall Street?
That's the whole thing. I mean,
yeah.
You're going to have increased borrowing by the federal government at probably higher interest rates. So the borrowing costs are going higher. At the same time, the Federal Reserve has stopped for quite some time now outright quantitative easing, and they've initiated their balance sheet management program, which by April should be a net extractor of liquidity from the economy. So the central bank is stepping away from the plate, and China and Japan, our other good customers, are also talking about moving away from the US dollar. Ultimately, this is a deep hole that if Rand Paul is not crazy. He might be eccentric, but he's not crazy. There is a reset button somewhere. And if we travel far enough down this path, they will have to hit the reset button, and that's when you will see great loss in confidence in the U.S. dollar and the U.S. government's ability to meet its obligations.
But in terms of liquidity, Powell comes out today and saves the day, yes?
Oh, you can save the day for now. I mean, the fact is that earnings growth is still there.
Yes.
On the surface, the economy is still fine. I mean, fundamentally, there are good reasons to be long the market for the next, in my opinion, 2+ years. I think down the road, though, we do face a reckoning.
Okay, any other macro data before we move on to those fundamentals like earnings that our viewers need to know?
Well, sure. I mean, you have retail sales, same day, Wednesday, as CPI. These two matter a great deal for GDP expectations for the first quarter. You're also going to get business inventories, which is a big deal for economists, but this is a December number, so you're talking about Q4. So when we had that disappointing GDP number last quarter, this is where it has a chance to be revised higher if there was any inventory building across several business lines. You'll also get industrial production and capacity utilization later this week. Those are also important numbers as far as GDP goes.
Cool. Okay. So we heart what's coming out on Valentine's Day. It's not going to ruin our sentiment in the meantime. But yes, company news. We have Coca-Cola reporting on Friday. Pepsi today.
Disappointing,
the
right?
Drama.
Soda sales are down. Well, who would have thunk it?
I'm not a Pepsi person. Just saying that.
Well, there's a time when I like a good cola. I'm not going to lie. I think I'm in the minority now. Obviously, sales are declining for this. If Pepsi didn't have Frito-Lay, they'd probably be in the same bind that Coca-Cola is, scrounging for other sources of revenue besides their headline products. I made a little money this year on Coca-Cola. I'm not in either name right now. I like Quincy, the guy who's running Coca-Cola right now. I think he has a good head on his shoulders. I think he has the right game plan. I don't think I want to be long it right here, right now, but it is a name I'm watching. Pepsi, I've got to go through the numbers a little better than I was able to do this morning. I didn't have the time. But I'm not long Pepsi either, and I have no intention of creating a position.
No, it's okay. So Coca-Cola is going to be a KO knockout, is what you're trying to tell me.
I
like their product better. I'm just saying.
Well,
I really do.
Actually, so do I. I think
Pepsi
they have a good core product. I think some of their other tertiary products are also good. You know, was it Sprite and the like. And they're focused. They're focused on beverages. They don't have other business lines, although that's a strength for Pepsi. It could ultimately one day be a strength for Coke that they're more centric in where they go.
Well, in science news, they're now trying to prove that sugar was just a facade, that it really wasn't that bad for you. So maybe they'll...
Well, probably everything is okay for you in moderation.
Yeah.
I mean,
that'll be our nutritional show on the weekends. Okay, Stephen. Now let's finish up with a big topic. You kind of mentioned a little bit before: leveraged products, volatility. That was insane. So a lot of people, it's still the buzz. A lot of people don't even understand it. So let's explain it.
That's the volatility products that blew up the marketplace for about a week and a half. That caused all this volatility. Really, what it is, it's a leveraging of risk. It's a leveraging of the VIX, the volatility index. And these exchange traded products, which are broken down into funds and notes, they're both dangerous, but the funds at least hold a basket of securities that are in line with their strategy. The notes, however, are underwritten by a bank note, basically. And that's the one that went down for the count, the XIV. I think this is an exceptionally dangerous way to go because it introduces credit risk along with the volatility risk. And now you have somebody who maybe be trying to hedge a position and they don't really know what they're involved in, because a lot of people, even professionals I talk to, don't really understand these correctly. But you might be buying on margin a product that introduces credit risk and is leveraged or inverse in nature.
So then you're messed.
What you're doing is tangling a web that is hard to unweave. When you wake up one morning and you have a $90 product, and you go to bed with a $4 product. And
$4.22, I think it came in.
And you don't know why. So.
Any other products, leveraged products out there that we need to be afraid of?
Well,
or is it cool to use?
There's a lot. Well, what I'm especially, I guess, afraid of in this field, the total exposure of these exotic products is thought to be only $1.5 billion, or $5 billion, which is not that big a deal. It's not systemic in nature. What I'm afraid of is that pension funds, something like that, we don't know. They might not be in these exotic products, but they might be mimicking the strategies. They might be going places that we might not know, and the exposure throughout the marketplace, if these other funds are involved in similar activity, is thought to be over $1 trillion, maybe as high as $1.5 trillion. So we don't know if the danger is still out there until we have another violently downward day and we see how things behave.
Yeah, true. And I tried to warn everyone about the inverse VIX. I mean, there were right. Remember when we were talking with Jim Rickards back in December? How many open positions? I mean,
I'll tell
didn't go to 100 like I try to call it, but
I'll tell our people out there the guy I go to for understanding these is Peter Shearer at Academy Securities. He's simply the best at this, and I really don't formulate my opinion until I know what Peter's thinking. I might not copy him exactly, but I really want his brain inside of my brain when I go to something this complex.
Well, it was certainly rocky, and we did see last week market on close order. Did you see that one day? It was insane. Maybe those were a bunch of margin calls.
Yeah, well, that we've seen in the last few days. We have seen margin calls and we have seen short squeeze.
Yeah,
so we've seen people get burned on both ends. Sometimes one morning after, within 12 hours.
And we have a cartoon of that. If you're getting squeezed, you gotta take cover.
Yeah. No, so it's been a bad time for a lot of traders, a lot of investors.
Yeah.
A lot of the emails I got were from people who were really feeling a lot of pressure, and they were scared.
Well, in times like these, I know options sounds really scary. I think that it could be a useful tool for the volatility that could be coming ahead.
Yeah, I mean, and options. I use options just to manage my average cost in any given name. I'll sell puts as a way to build a portfolio. Now that can be dangerous; you can get run over. But I also covering calls through writing options against your long positions. Yeah. That's a great way to really manage your entry point, especially if it's not working for you. So why not? I mean, I'm doing this on a regular basis in General Electric. I'll mention one of my lousy positions.
Okay.
And like everyone else, I bought GE at the wrong place and it went past where I bought it. Now I've done, I think, a pretty good job of managing my costs down because I've been selling calls the whole way down. There hasn't been really a lot of opportunity to be called away. So I've actually, even though I started buying GE around 27, my average cost now is below 18.5. So I'm really not too far from being in the game.
All right. Well, Stephen, I think that I think in one of our episodes, we should take the time to explain options for our viewers. I think we even have a viewer suggestion to do that.
We do.
What do you think? You want to do that next show?
We can do options.
Awesome. That'll be our eye on something. And that about wraps it up for the show that we still need to determine what the name is. Maybe you guys can tweet out some ideas.
We would love your ideas.
Yeah. It's the pilot for now.
So signing off, she is Olivia Voznenko.
And he is Stephen Sarge Guilfoyle.